Hello, everyone, and welcome to this Legal 500 and Olajile Oyewole webinar, adapting to a new M&A landscape, a consideration of the key factors impacting M&A trends and the role of ESG and sustainability in future transactions. My name is Joe Boswell. I am the head of the Legal 500's GC Powerlist series, and I'll be introducing today's session. This morning, we are taking a deep dive into the highly complex and technical world of mergers and acquisitions. If you have questions at any point, please use the Q&A function at the bottom of your screen, and our panel will do their best to answer your question when they get a chance. We have an extremely qualified panel to tackle today's topic. Our distinguished moderator, Samuel Salako, will introduce them in one moment. So, Samuel, please take it away.
Okay, thanks, Joe. Good morning, everyone, and thank you very much for joining us today. My name is Samuel Salako. I'm a partner in Olajide Oyewole LLP. Just a brief introduction of the firm. Olajide Oyewole is a member of the DLA Piper. We've been around for about 65 years. It's a full-service law firm, and we have about 60 lawyers. We are located in Lagos as well as Abuja. And today we have decided to have this webinar looking at the landscape of M&A in the past year, as well as looking at what the M&A landscape is going to look like in the coming year. The topic of the webinar today is adapting to a new M&A landscape. We're considering key factors impacting on the trends, as well as the role of ESG and sustainability in future transactions. So basically, the discussion by the panelists will center around what has been happening globally in terms of M&A, especially in Nigeria, looking at the challenges in Nigeria, and now ESG is actually impacting on how M&A is being done, and what are the regulators doing in ensuring that ESG is becoming a topical issue in a lot of transactions, especially multi-jurisdictional transaction is impacting on those transactions. So before I introduce the panelists, just a little bit of housekeeping. So we would mute all participants during the panel discussion. If you have any question, please indicate that in the chat box. I'm sure a lot of us are professionals now in attending webinars and how these things are done. Just a quick reminder. At the end of the webinar, the panel discussions, we'll take questions. Hopefully, we have enough time to take as many questions as we can. But the overriding things I would try as much as possible to take as many questions as possible, especially as it impacts on the discussions that we've had. So let me quickly introduce the panelists, and I'll be starting with the female, the only female panelist today, Tinuade Awe. So she's the Chief Executive Officer of the Nigerian Exchange Regulations Limited, which is a subsidiary of the Nigerian Exchange Group, PLC. That's what we formerly call the Nigerian Stock Exchange. Before her appointment as the CEO, she was Executive Director of Regulations at the Nigerian Stock Exchange. She was tasked with ensuring that the stock exchange carried out regulatory activities in a compliant fashion, and especially in the light of his mandate of protecting investors. She was a member of the Executive Committee of the Nigerian Stock Exchange from 2012 to 2020. She also served as the Secretary of the Nigerian Stock Exchange Council from 2011 to 15. She was head of the Legal Department from 2011 to 2012, and head of the Legal and Regulation Division 2012 to 2017, where she served as the General Counsel of Nigerian Stock Exchange. In a previous role, she has served as law clerk with the UN Criminal Tribunal for the former Yugoslavia at The Hague, and an associate legal officer at the United Nations Compensation Commission. Tinu is a recipient of several awards and honors, including General Counsel of the Year at the 2018 Africa Legal Award, amongst other awards. Please join me in welcoming Tinu. Our second panelist is Dipo. Dipo Kurobido. Dipo is the Vice President within the Legal Department of Vero Capital Management. Prior to joining Vero, He was a senior stay with the Bawa and Igudalo with experience in energy, tax, capital market, and finance. He has more than 16 years in advising a wide range of clients from different sectors, looking at breweries, oil and gas, manufacturing, FCMG, and he's received his LLB from University of Lagos and an MBA from just College, University of Illinois. He's an alumnus of the International Lawyers for Africa program. Please join me in welcoming Dipo. Thank you, Dipo, for joining us today. The third panelist, Chuka. And Chuka is from Uru Capital. He is the vice president of the investment firm, a private equity firm focusing on investing in businesses across West Africa. So he brings with us to us a multi-jurisdictional experience. We're responsible for the deal origination, deal execution, diligence, and monitoring of portfolio companies. Chuka is a seasoned investment professional and has worked at best-in-class equity firms such as Africa Invest, Capital Partners, Kaizen Venture Partners, and has led M&A and financial advisory transactions at PwC prior to these experiences. He's gained operational experience as a C-suite executive, as a CEO, COO, and CFO in some companies. He has a master's degree, I must start with the distinction, in financial analysis and management from University of Exeter, UK, and a bachelor's degree from University of Lagos. We have quite a few alumni of Lagos. He's a CFA chartered holder and a chartered accountant. He's also the vice president and member of the board of governors of the CFA Society in Nigeria. Chuka, welcome. Our fourth panelist, unfortunately, had to travel at very short notice, but be no doubt that the panelists they have experience to cover the questions that we are going to discuss today, and they will give a very good account of what the landscape is and what we should be looking at in the immediate future. So, Chuka, I'm going to start with you. This is the reason why we're here. So we've seen, my first question is on valuation. You know, valuation is very key to a lot of M&A transactions, and is key even in managing ongoing portfolio companies. So we've seen a lot of write-downs in the last couple of years. You know, and the reason is actually multifarious. You can look at, foreign exchange. You can look at even the global recession, especially the global recession that seems to be affecting everything, including all the news we are hearing, you know, regarding layoffs and even performances of blue chip companies, you know, all over the world. So what should we be keeping an eye on in the next few months in terms of valuation?
Okay, yes, thanks, Alako. It's quite interesting. I mean, if you look at history, you see valuation go up and down depending on, you know, people's sentiments. So the world, the global economy is not static. And typically what happens is as liquidity dries up, you'll see that, you know, the ability to do deals or the willingness to do deals reduces. So there are fewer buyers. And you also see a situation where sellers feel that, well, you know what, I basically walk away from a transaction because they have a certain, you know, sense of entitlement on the value of their assets. And I mean, that's a logical behavior. So the expectation is that, you know, valuation and prices, prices generally would be low for now until the global economy picks up. And typically, it doesn't mean that there are no good deals. There are definitely good deals. And what deal makers need to look out for are those, you know, fantastic opportunities. Now, just to give context, Africa has a very large population and is expected to account for 25% of global population by 2050, which means that the international strategic players that operate in environments where, you know, the population is declining would have to look to Africa, we have to look to businesses in Africa that are already, that are positioned to take care of the customers. So basically the large population. The interesting thing about Africa, or the value proposition of this environment, is that it's a bit disorganized. So what it means is that the international players would want to, acquire those businesses that have already, solved the problem or the challenges of operating in this environment. So typically, as a deal maker, I'll be looking at, those type of companies and businesses that address this issue. Another critical point is the importance of ESG as well as anti-money laundering. So basically, the companies or the local companies that are positioned for strategic acquisition are those that are already complying with ESG and have a very strong anti-money laundering policy. I'll take a break for now.
Okay, thank you very much, Chuka. I don't know if Dipo has any take on that question quickly, just to further buttress perhaps what Chuka is thinking in terms of the landscape for the next 15 months.
Okay, I mean, happy to comment briefly. There's something that they say, I think, in politics about all politics is local. In a sense, it's similar with investments. I mean, it's not always, in fact, it's seldom the case that global trends necessarily percolate into local context. So what's happening on the international level, or what's going on in the US and in Europe, which is getting a lot of the international press, is not necessarily what's driving the situation in Nigeria. I mean, Chuka makes the point already. The number of people in Nigeria and in Africa in general is continues to grow. The population in many of these developed markets continues to slow. Those things are constant and they haven't changed over time. I think in the days of easy money, there was somewhat of a boom, particularly in the VC space, maybe less so on the private equity side. And people were then, a lot of deal making was driven by the idea of I don't want to say greater fool, but the idea of the person that will come and take you out rather than what might be in the business. So you think about a business from how you can dress it up to sell it, rather than what actually is in the business and what you can make. And so what you expect to see when the tide turns, when money is no longer easy, is a return to fundamentals across all segments. So now it's no longer, when people do deals, when people are looking at acquisitions, it's no longer significantly about how I can dress this up for the person that might buy me out. Is this actually a good deal? Is there a path to profit here, or is there profit already? It's back to fundamentals in the businesses. And I think what that does is, on the PE side, it doesn't change much, because the truth is local investors in private equity always in these markets always recognize that their only way out was that on fundamentals. Maybe on the VC side, there will be some shift, because a lot of the entrepreneurs there were getting carried away with their suddenly newfound fame. And I think that balance of power is shifting. So on that side, you may then see people coming back down to earth and understanding that their business is no longer valued based on what the next person might think, but actually based on what is in the business itself. So maybe on the VC side, prices might come down a little bit, and there will be a shift of leverage in favor of investors. On the PE side, particularly in places like Nigeria, Ghana, it will just be the people that, to a large extent, it will be business as usual. People that were doing deals were always taking their time, always focused on fundamentals, and they will continue to be so. And the companies that were attractive always recognized that they were attractive, always had a sort of large impression of themselves, and they will continue to be difficult. So you might not see too much movement in terms of pricing there.
Okay, thank you very much, Dipo and Chuka. I think this next question, it's similar, but we're looking at it from the investor's perspective. I haven't seen the sort of write downs, they put in money, in the course of the previous regimes, and they've seen a lot of write-downs. So some of them have lost money. What are you going to be telling the investors at the moment to tell them that, look, there is actually a way to win in the current climate? How do you get their trust back? Chuka, do you want to have a go?
Yeah, sure, definitely. So it's again, it's relative, right? If you've made very good deals and you've been conservative in evaluating opportunities, yeah, you wouldn't really struggle much in terms of getting the confidence of investors. But again, I'll come from the perspective of the general market sentiment, which is, prices of assets are declining, prices of companies is declining. I mean, yeah, the price can decline. It's just a function of how excited people are about an opportunity. We don't change the fundamentals, and that is something that Dipo had actually mentioned earlier. So as long as thorough due diligence is done, as long as you're not really being sentimental when looking at an asset or an investment opportunity, you'll be able to, and you're able to get effectively the thesis of that opportunity. You'll be able to get the confidence of your stakeholders. So let me use an interesting example. At Uhuru, there is an opportunity we looked at. For several years, we had been in touch with the company, with the promoter, and we looked at the business. During the recession of 2015 to 2017, when many companies struggled in Nigeria, this company grew by double digits. Basically grew by double digits, over 20% growth year on year, and margins remained the same. Attractive company. And during COVID, the growth of the company slowed down. Now that would get everybody scared that, look, do not invest in certain businesses, or take a step back in making any investments. But the interesting thing about this company is that it remains relevant to the consumers. And the reason for the slow growth was because, the banks had actually, withdrawn the credit lines, because during COVID, everybody was scared. People just didn't know what was going to happen. The banks were also scared. So for us, it didn't mean walk away from the business because, the economy is bad, prices are declining and all that. No, it's for us, we actually saw a better opportunity to, to invest in the company and even get a better deal, take advantage of the declining price. So the point here is this: if you do a thorough due diligence, if you do rigorous work on the assets you're looking at, and you're able to communicate this to your stakeholders, I think you'll be fine. But if your assessment is really emotional, it will come out clearly. So yeah, so my advice is for people to just, for deal makers, to continue to, to continue to look at the fundamentals of businesses, regardless of, what is going on in the economy and the prices.
Thank you very much, Chuka. Thank you very much. That's quite some good news to hear. Dipo, any take on it, or we just move on to the next one? I saw that you were smiling when he was making some points.
I was going to say, maybe you can sort of take it to a meta level. Chuka says you focus on fundamentals of businesses. In a sense, when you think about how you win back the trust of investors, it's less of winning back. They also need to focus on the fundamentals of their investment managers. Where in easy money times, everybody's an investment manager. So people are doing the hard work and walking away from some deals and staying in the ones that they think have potential. Somebody else is just throwing money at everything. And if you are an investor, you are seeing the guy that's just throwing money at everything and you're backing him. When, how they say it, when the tide goes out and we can see who is swimming naked. Well, it was on YouTube because you weren't looking at the fundamentals of your investment managers. You were just backing the guy that was active. So in a sense, like people like people like Chuka, people like me, we are really happy because now now that the tide has gone out, we can then see that like the market is really for people that are ready to roll their sleeves up and do the work, not just for anybody. So we don't feel like we have a problem winning trust. If anything, there's more attention now for good people.
Okay, that's very good. Thank you very much for your take on it. Chinade, I hope you're still with us. So
Yes,
we want
I
to
am.
look at some around the topic of valuation. So basically, yes, M&A can happen at different stages of a company's life. New companies, listed, unlisted, the companies on the main board and any other one. Now, you lead J&J's rules and regulation making entity. What benefit do you think an NGS-led ESG regime can add to company valuations and attractiveness to investors?
Okay, thank you very much, Samuel, for that question. And I'm really pleased to be here and listening to Dipo and Chuka. So I think ESG issues, I'm one of the most happy people for the fact that ESG issues have come to the mainstream. And there seems to be like a meeting of the planets around a lot of what is happening in ESG and has been happening over the last couple of years. And if you keep reading in this area, you can see that the value of ESG assets generally is growing around the globe. So there's some numbers that are saying that they're tracked to exceed 50 trillion by 2025, which is more than a third of the projected numbers for global assets. So it's a space that anyone that is involved in the buying or selling of the company has to pay attention to. Now, what are some of the benefits that I think, and why do entities like NGX regulation, which I lead, why are we so interested in this? Well, people talk a lot about the reporting end. When they think about the regulation, they think only about the reporting end, and they think about the onerous issues around reporting. And as a regulator, I'm not going to minimize that because you do have to prepare yourself to be able to do reporting. But really, one of the things that the due diligence in an M&A is supposed to throw up is, what are the risks? Okay, I'm a company and I want to buy another company. What are the risks that are in that company so that I can give it the appropriate valuation? And with the increasing importance of ESG, what sellers are doing is trying to find out what are the ESG risks in the company as well. So if you, for example, want to buy a company that makes soft drinks and everyone's concerned around water and water shortages, does the planet have enough water? And water is a major ingredient in soft drinks. Surely you would want to see what processes they have to deal with the potential shortages of water. Do they have devoted supply lines for water? Do they have, are they thinking about other alternative sources of raw materials beyond water, for example? And so in your M&A valuation, seeing those processes that the company has for things that are vital to it is very, very important as far as they relate to ESG. And so I think it's just something that M&A has always done, but there's now a critical look from an ESG perspective because of the realization of the importance of sustainability issues. And really, it can lead to a lower or higher valuation for a target because nobody wants to be held holding the baby. I think that's one of them. So for entities that want to make themselves more attractive targets, ensuring that they already have the processes and procedures that they can show folks who are interested in them to deal with ESG issues, ESG risks that they have is very, very critical. So in Nigeria, for example, one of the things that I think we're all concerned about greenhouse gas emissions. Do people understand the different types of levels of greenhouse gas emissions? Do they have the ability to measure? So do you have the ability to measure the greenhouse gas emissions based on your own, your own actual production? Do you have the ability to measure when you have a product? Do you have the ability to measure the effect of the use of that product on greenhouse gas emissions that come from the use of that product, or even more critically, all the components that you use in building that product. Do you have the ability to measure the greenhouse gas emissions that your ecosystem is using to give you the components? And what we find is, because of generally a lack of data or a lack of capability around these issues, people may not have all of this information, and it is something that more and more buyers are going to be looking at. And so as a Nigerian company, I think one of the things is try and figure out, try and get the capacity, try and understand, and don't just treat ESG as something by the side. I think another thing that's important is that we're seeing that it can help to establish long-term synergies for both. And so you have different types of deals. You have ESG motivated deals, where what the entity that is buying is actually trying to find a company that will help it to increase its own ESG compliance. And so, for example, you had Occidental Petroleum, one of the top US producers in the Permian Basin, that acquired solar generation assets to power its drilling and completion operations. And then you had another example of Ferrero, the chocolate makers, acquiring Eat Natural, again, towards healthier eating. Then you have ESG conscious M&A, where, so, in those two examples, those targets obviously were attractive to the buyers, because those buyers, the buyers needed to be able to prove that they were in that space for their business. So that synergy was what made, it's not that they couldn't find any company, but the fact that those target companies had something that the buyers were looking for, and it was along ESG lines. So that's another benefit. And then you just have the ones that are not that specific in terms of, I'm looking for a company that's already in the ESG space, but looking for a company that is in my value chain, that is, has the same sort of ESG thinking. I'm not going to have to start talking to people about the issues. They already understand it. So that's, I think, another benefit that comes. I could go on and on. I think, I'll stop here, and I'm sure that people will have questions. Thank you.
Hey, thank you very much. I'm definitely coming back to you on what you are doing in terms of that space. Let me quickly go back to Deepo. So Deepo, we've seen quite a lot of deals collapsing because of national security or critical national interest, consideration all around the world. I mean, we can name quite a lot of that, and currently we know some companies are going through, certain competition and review because, of the effect that they have on the general market. So typically, what sort of factors has given rise to FDI regimes, as foreign direct investment, regimes, and how would these regimes impact on, M&A transactions going forward? At the second leg of the question, if I can take them together, is, do we have such factors in Nigeria that can prevent some investment being made?
I think this is one of the areas where I was talking about before about, politics being local. The truth is that you need to be a US or a China, or maybe or maybe EU, not even necessarily UK these days, to be in a position to say, foreign direct investment is coming, but we want to assess whether it's foreign direct investment that we are comfortable to accept. I think in markets like ours, most of the developing markets, particularly, West Africa, places where we invest, there just isn't that luxury to pick and choose. Maybe an obvious example is like Huawei. There's been a lot of noise about security concerns. It's even subject to sanctions in the US at the moment, but it's all over the news. African countries need their 5G infrastructure built out. These guys are ready to help. Money is ready to come from those sources. The governments just aren't in a position to say, hey, we are assessing security concerns. So you don't really find those same kinds of FDI controls in most African markets. There just isn't that freedom to pick and choose. I think what's driving the general trend is just a push to protectionism and perhaps the geopolitical issues between China and the US. But I think what you might see maybe in Nigeria, less so in some of the other African markets, is a strengthening, or what we've seen is just the strengthening look from a competition perspective. And this, I don't, to the best of my knowledge, they aren't necessarily preventing deals. They just want to be sure that they are reviewing. And I mean, people in my industry complain a lot about it because it feels like one additional hurdle, significant additional costs. But the truth is that over time, alternative assets, private equity, VC, they've invested in industries that are relevant and sometimes in different aspects of the value chain. We are invested in a pharmaceutical manufacturer and a pharmaceutical retailer. You might find someone who's in a bank and in a payments business. And I mean, it's all well and good to argue that you're not buying two competing businesses and there isn't an obvious competition issue there, but the possibility of some collaboration in a way that isn't necessarily the best interest of consumers still exists. And if you have a sizable stake and forget the terminology they use now, basically controlling influence over two companies that are in a vertical relationship, you can easily, not that you necessarily will, but you can abuse that position. So it's not unreasonable for authorities to want to review things like that. I know Chuka might have a different view, but that's what I think.
Chuka, any view on this?
Nico, why do you think I'll have a different view? Okay. Yeah. So I would say my view is different. It's just that basically where we are in Nigeria, and where it's not a major issue currently. However, what is very critical, or what this actually highlights, it's the importance of having a very strong relationship with the government, and also planning transactions. So using the US and China and basically the different countries trying to protect themselves. I mean, deal makers typically should try to at the very early stage try to work with the various stakeholders on transactions that could be deemed to have a serious national security impact. And that is the mentality that should be adopted across board. So even in Nigeria. But the good thing is that currently, I don't see a negative impact on transactions in this market.
Okay, thanks, Dipo and Chuka. So for those of us out there who are not Nigerians, so what Chuka and Dipo are saying is that there are no such national security or national interest considerations. Of course, from my own experience, as Dipo said, any such restriction will be in the competition space. I mean, we wouldn't expect big telecoms companies to merge or be acquired by the other ones. Or in some instances, we've had where some big telecoms, entity were more or less restricted from setting up payment service banks until certain parameters are met, or acquiring certain customer database because of this consideration. So apart from anti-competition or abuse of dominant position, I think any sort of investment can actually be done in Nigeria. We don't have such restriction on national security restrictions. So Chuka, this is for Adipo actually, the forex issues. You're seeing what has been going on in terms of restrictions and such shortages, and how it is very difficult for investors to exit or even to repatriate any proceeds of whatever. Now, looking at this, what do you think is going to be the long-term effect of this forex shortage on M&A deal volume in Nigeria? There are two questions, but let's quickly run through the first one. What do you think is the long-term effect of these shortages on deal volume? Dipo? you want to go first, or Chuka? Feel free.
I mean, happy to go first. Long-term effects. I think maybe it's more work for professional advisors. It's it's not the first time we're experiencing this in Nigeria. You know, the determination to defend, to fight what is probably a losing battle, defending the currency that then forces people out of or discourages people from using the official market and then leads to a shortage. Deals still need to be done. The opportunities are still in the market. I guess people just need to then figure out structures that allow them to do those deals in ways that they aren't exposed. I mean, every now and then there's non-deliverable futures contracts that CBN offers at attractive pricing. So people sometimes look at that. People sometimes explore scenarios where you might keep your USD offshore and then structure perhaps some Naira debt, which you can then use to fund the investment, pending when there's more supply and you're more comfortable to unwind. I think the bigger problem is on the exit side. On the exit side, people are stuck. So the expectation is that you then start to try to do deals offshore, assuming, where it's possible. If an investor invested through an SPV, instead of selling his stake in a Nigerian company, he might look to sell the stake at the offshore level. I mean, the good thing is with recent capital gains tax that has been introduced in Nigeria, it's actually probably also more tax efficient to sell at the shareholder level rather than at the company level. So what you find is that people do a lot more work trying to structure their deals. And so in addition to negotiating the commercial terms and the standard legal stuff, you then have to apply some time and resource to structuring the deals as well in a way that ensures that you get best value when you're entering, but also improves your flexibility from an exit point of view. I mean, it might slow some deals. It will probably complicate a lot of deals, but beyond that, people that are investing based on fundamentals, it's difficult to stop investing. The hope is that you can keep getting by until the CBN sorts itself out and then supply can increase in the markets again.
Sorry, I think I was muted. So before you go, are you saying that these forest issues has not really slowed down transactions, and you don't see it affecting transactions going forward?
No, I mean, it slowed down the process of executing transactions. It's complicated the process of executing transactions. But I think if I'm a Nigerian fund manager, I am committed to investing a sizable portion of my funds in Nigeria. I don't really have the luxury to say that, for the next 18 months, all sorts are going on with CBN. I basically just put pause on my investment plans and wait until the issues in the market are sorted out. I don't have that luxury. I imagine that, I mean, as with many other things, the situation is probably impacting external managers that Nigeria is one of a bouquet of opportunities that they are considering, but many things impact them. The reality is that if you are a manager in South Africa or in the UK investing across frontier markets, you may think there are elections in Nigeria in 2023. Let me wait until after the elections to see how things go. So elections will slow down your pace of investment. If you are a global manager and you're investing across the world, you would think with interest rates on the rise and the risk premium that you require from equity investments also rising in turn, maybe this is the best time to take those massive risks on unproven or difficult markets like Nigeria and Ghana. Maybe I should go to places that are a bit more established. Maybe I'm thinking the US is still quite tapped. Maybe I'll go to Asia where it's a bit easier. So those people that are sort of taking a broader perspective that Nigeria or like West Africa or Africa is an option, you might see many things that slow them down. FX will be just one of a range of factors that are slowing them down. But folks that have raised capital for investing in this market, they just don't have the luxury to to put pause to their plans. And I think FX is just one of a range of challenges that they experience from period to period that they have to navigate. And if you are investing in Nigeria, security is something that you have to come to terms with. If you're investing in Nigeria, beyond the short term, I mean, it's becoming a bit more than short term, but the current FX shortages, you have a broader problem of you are raising your funds in USD and the Naira is moving in one general direction. But you won't say that you are waiting for only the times when the thing is stable to invest, because I mean, those things don't move linearly. You can't be predict. You won't just be investing in these markets.
Okay, interesting. Thank you very much, Dipo. I think we've touched on part of the next question I wanted to ask, which are some of the mitigating, mechanism or techniques I've been using for that. Chuka, any take on this particularly hot topic right now?
Okay, you mean the impact of the...
Yes, how has that affected deal volumes and what should we be looking at? And how do you mitigate the effect of that on transactions?
Yeah, so basically this issue of the FX shortage has been on for for a while, at least a year. I mean a couple of years, and it's what has happened is that different investors as well as strategic players have already taken a view on whether they want to continue to invest in Nigeria or not. And so this has a greater impact on portfolio investors than long-term investors. And when I say long-term investors, I'm referring to private equity as well as strategic players. Now, the private equity guys are relatively, I would say, medium-term. So this FX shortage is usually a key consideration, but the FX shortage is temporal. It's just a temporal problem, and the expectation is that it won't be the norm, in the next 5 years or next 4 years or thereabout. It's not sustainable. For the long-term players, the big strategic players, whether there is an FX squeeze or not, they're basically looking at the fundamental of Nigeria, the markets that they really want to operate in and actually want to create value in. And if from that perspective, I mean, they will still be looking to invest and do deals. In fact, I recall that Unilever increased this. Unilever, the parent company basically increased its stake in the Nigerian entities, and there are some other companies that have done that because with the depreciation in the value of the local currency, it means that local assets in Nigeria become really attractive.
Yeah. Okay, thank you, Chuka Dipo. Tunade, from the exchange perspective, has this affected volumes on the exchange? And is there anything the NGX is doing to provide liquidity, especially for foreign investors, and improve confidence in the markets?
Okay, thank you very much. So I think generally, certainly when the exchange has spoken to investors, and I have to be very careful here, Samuel, because I work with NGX Regco, not with NGX, which is the exchange. But as a member company in the NGX group, I think that I can say a couple of things without doing any damage. So I think that obviously the issues around the foreign exchange have been a major issue that we have had to face within the exchange. And what are some of the things? Some of the things are simple as foreign investors coming in and then not being able to take their money out. And they have certificates of capital importation. They, at the end of the day, they want to repatriate their money, they want to repatriate dividends, and they're queuing up to be able to do that. And so I listened very intensely when Dipo was speaking, because I think the experience that we've had, to my knowledge, has also been of people realizing that there are hiccups and that there are challenges that they have to face. And so structuring in such a way that they will be able to deal with those challenges. Whether they take greater stakes in companies that they have here already, such as the example that Chuka has given, or whether they engage in other activities that would help them to retain their money within the country, but in a way that they don't entirely lose value. I think the effect is, as you may have seen, that the numbers of foreign portfolio investors has reduced. There was a time when we had like 60-40. I think the numbers are greatly reduced, and before the end of this webinar, I can actually take a very quick look at our latest numbers for last month and let the participants know. So we've seen the problem. What are we trying to do? Well, it's a market, and so a market is a place where everybody comes, and we can intermediate not only securities, but we can intermediate views. And so when people come to us, or when we go and investors speak to us about these issues, we do let policymakers know that these are issues that are out there and that they're affecting the market and affecting the economy in general. I think one message that we've always tried to pass is not so much on the quality of the substance of a policy, but that the policy should be consistent and consistently applied. So if this is your policy in Nigeria, then apply that policy, and everybody knows that that's the policy. I mean, there are other countries in Africa, and I'm not going to name names, that have exchange controls, but everybody knows they have exchange controls. And so you value it into the risk of coming into the country, and everybody knows what those exchange controls are. I think one of the challenges that investors have told us that they have with this market has been sometimes a certain level of unpredictability around around it, and therefore increasing the risk of participating in the market. Obviously, the things that we also try to do are to try and do the things that are within our control. So the intermediation is just simply saying, this is it, government, can you think about this? Can you do this? Can you be consistent? And so on and so forth. But what is within our control to do is to continue the engagement, is to ensure that the policies, the procedures, the rules that we have are rules that from a global perspective, people understand the rules. And so you don't have a different set of rules that doesn't compare with what you would have in other markets that they're used to. So whether it's the disclosure standards or the standards around what insiders do, the standards around the times for submission of accounts, and so on and so forth, we try and ensure that those, at least because they're within our control, they're consistent with what people will find elsewhere, so that the numbers of different parameters that they have to be, as Dikbo said, thinking about is reduced, because they can say, okay, this looks like what I have in other markets, so I'm fine. This looks like what is in other markets, so I'm fine. So that's really it. But we don't see people leaving Nigeria. I think Nigeria is a very important market. It's just that we need to make it easier for them to be here.
Okay, thank you very much, and thanks for the sharing conclusion, which is that Nigeria, people are not exiting, and it still remains, despite the challenges, an important market for investors. So, Dikbo, we go to the next stage of this discussion, and that's regarding things that have to do with, I think, what you do as a legal person in-house. So, looking at what the impact of COVID, on how these are done, how these are structured. We're looking at issues of staffing, especially around this part of the world where you have a lot of people exiting every now and then, or even some of the news we had last year of founders being, particularly unfriendly to staff, or, general HR related issues. We've seen a number of founders being accused of fraud, and, the investors or major investors, taking over the company, around the company, are finding also. Incidentally, I'm currently handling one at the moment, and it's quite a story. Now, all these issues, how have they impacted on due diligence requirements and the way these are structured?
I mean, in some sense, it's back to what I was saying before about good people and bad people. But I think one point that always comes to mind when we talk about ESG in general is in emerging markets, investors have always, like, a huge portion of the investor base has been developmental finance institutions, impact institutions that are concerned about ESG issues. So most fund managers that are investing in a lot of African markets are already have extensive ESG obligations that they have to meet, which means that from the beginning, as part of their due diligence, they've always done some DD. I know we do it. So when we sign a term sheet, we are thinking about financial and tax DD. Sometimes we're thinking about commercial DD. Depending on the business, we might think about technical DD as well. We'll do, of course, our legal DD, but it's always ESG DD has been a part of it. And this involves actually hiring consultants that assess, the environmental side of things, how the operation is being carried out. Is waste being dealt with properly? But in addition to those things, also the social side of things as well. These guys are reviewing the employment handbooks and interacting with relevant key employees, not just to determine are they complying with the law, but also to understand what's the dynamic in the business. Are they actually treating their people well? Is there a potential reputational risk that can come out of this? So this is something that we've done in the past, and it's the area where a lot of this kind of things come out. I mean, we had a business we were looking at in Ghana a few years ago that it was quite labor intensive. So they had a lot of employees and they were very proud about paying at least minimum wage. And then the ESG consultant spent some time talking to the folks in HR, talking to a couple of people, and then it started to emerge that actually how they get to that minimum wage is by some sort of compulsory overtime, which means that it's not exactly minimum wage. But I mean, this is the kind of stuff that you don't necessarily discover without actually focused due diligence into those kinds of issues. So it's something that a lot of firms have always done, but it's something that will be increasingly important. And if you were a strategic investor who maybe hasn't yet caught the bug of ESG as a big issue and as compulsory for you, just seeing all the reputational damage and things is also then making you do that ESG DD. I think maybe what's a bit newer or emerging a bit more is like an integrity due diligence. You make the point about founders and bad behavior. So what's happening now is I think in the old days, a lot of times when you were doing a DD, when you were looking at an investment opportunity, you do all the typical DDs. You may then do like a check on a sanctions list. So there's a couple of sites that provide databases. So you check just to be sure this isn't a criminal convicted or this is someone that's subject to sanctions at the moment. And then that would be enough. But now with all the stories that are coming out and all the issues, people are then thinking, perhaps that's not enough actually. The same way we invest time and energy and have consultants look at the social issues going on in the companies, maybe it's also time to then have like a focused, substantive integrity due diligence, where you actually have external consultants actually DD the background to a bit more elaborate than your typical basic background check to really understand what kinds of people are these kind of people that you can actually be comfortable with. Is there a risk from their past? Is there a risk in their relationships that might be an integrity issue as well? So that's something that's emerging that people also do to sort of deal with those kinds of risks.
Okay, thank you very much for that. So we're seeing more focus on integrity, DD, and I think that's something that a lot of investors investing in some emerging markets would want to look at before they take the step. So Chuka, the previous day we're talking about the FCCPC. We're looking at the scope of the authority. We're looking at their approval process. It just seems like practically any form of acquisition of shares, whether it is large, of course the threshold is what it is, from private equity standpoint, it seems to be somewhat onerous that you have to submit practically all transactions to the FCPC. So what would you like to see in terms of the threshold and approval process?
Okay, yeah, thank you, Salako. But just one thing, regarding the previous question, I would just like to add for the purpose of the audience, the question on, the founder behavior. Is that fine?
Of course, that's fine. Yes, please.
Okay, so I agree with all the points that that Deepa has highlighted. The other thing from my experience that I've found that is really fundamental is the founder himself. So how receptive is he to, feedback? So I've seen some founders who, take some things that you've highlighted, not just ESG issues, but some things that you've highlighted in the business. They're like, yeah, we're not perfect. And, we're just not perfect. But they don't push back aggressively, but that's a subtle hint. And some others, the moment you highlight one or two things about the business, ESG or whichever issue, even while the due diligence is on, they are fixing those things. So when you talk about founders behaving or promoters not treating their staff well or behaving in unethical manner or things of that nature, most times it has to do with the person's attitude, because it's the head that actually drives everything. It's the tone at the top that really determines whether some policies or some policies would actually be well executed or not. Yeah, so that's the key thing I wanted to add. And the other thing is, by talking to employees, talking to bankers, people that have actually worked with the founder, you can also get very good insights beyond how the founder acts to feedback. I just wanted to add that.
Yeah, that's very, very, very good. Thank you very much. I think that's a discussion. Of course, it is very appropriate, especially in these climes and everything that is going on. So on the FCPC issue, just to quickly remind you, before I do that, please, the audience, I understand that we're all enjoying the panel discussions. Please, if you have any questions, please start sending your questions now, so that hopefully we will be able to have some time to take some of the questions before we close. So, Chuka, just quickly back to you. FCPC and the merger control approval process, the threshold, virtually capturing, every acquisition mainly. And this has caused some problems for PE firms, because, you want to do your business quickly and you're looking at these additional challenges. From a practitioner's perspective, what are these challenges and what would you like to see change?
Okay, yes. So yes, you're right. The implementation of the FCCPC process, came as a shock to many of us, especially those of us that operate in this market, because it's quite new. The reality is that there is value in it, and the reason I say that is that it has made us to consciously look at the impact of deals that we're making on the consumer as well as the employees. So it has made us to be much more conscious of it, which is actually good. However, like you said, yes, the process can the process is a bit straightforward. The challenge is the time. So it takes on the average of 45 days, to get the approval. And within that period of time, a lot of things can happen on a deal. So time actually kills deals. So the longer it takes for a deal to close, the higher the risk that the deal could fall apart. People could get tired, people could have deal fatigue, people could have a change of heart. And a lot of time has been invested in the process. So I feel that that's the timing it takes to get the approval, if it's reduced, I believe that it would increase the number of deals that that are made in this market, that could be made in this market.
Okay. Dupa?
I just want to
remind
Shuka that there's a fast track approach if you pay an extra 10 million naira.
I'm aware of it. It is that's a 10 million. That's significant in addition to all the deal fees that you've incurred. It's yeah.
Chuka wants to keep the money to himself.
well, I mean, if there's anything that the regulators can do, from on their parts to actually reduce transaction costs, it won't be a bad thing for practitioners, won't it?
No, I know, but I don't think that they like rich people like Chuka complaining about 10 million. No, but seriously, I think FCCPC, Chuka's point is right. Time can do things to deals, and sometimes it can be quite frustrating. Sometimes even the 10 million naira, it maybe buys you a guarantee of somewhere around 4 weeks, or 4 to 5 weeks, which is still quite a bit. But I mean, there are many challenges to doing business in Nigeria. This feels just like one of them. I think maybe the thing that I have my own challenge with FCCPC is just the dynamic around the clarity. It makes a point about how important it is to have a certain regime. But yes, I remember the term now. That whole material influence dynamic, it can be quite tricky. And every now and then you will be looking at a deal and you'll be able to tell whether this is a situation of negative clearance or this is a situation of regulatory approval. And these things matter because, sometimes the time is not even the problem. It's just the predictability of it. We've gone into transactions where one side interpreted the situation as a negative clearance situation, and therefore we're operating on the assumption that within a month to 6 weeks from signing, the deal will be done. But the challenge is that the FCCPC sees it as as more than just a negative clearance, as a full approval scenario, which means a significantly more detailed and therefore longer review, and therefore something that one person is plotting 6 weeks, all of a sudden starts to look like 12 or 15, which is significantly more. So that's problematic. I know that they've tried, but and maybe there's only so much that can be done. But if there was some, I think the negative clearance process seemed like it originally evolved as a way to confirm whether or not your transaction required FCCPC approval. It has evolved into a full-blown approval process itself. It would be in the old days when this used to be handled by the Securities and Exchange Commission. What people would do is you'd set up a meeting, semi-formal, not quite informal, set up a meeting. Advisors, maybe 1 or 2 people from the client will go together, sit with them in Abuja, describe, sometimes on a no-names basis, but sometimes even with some detail, just what you are thinking about doing, and they can share with you feedback immediately, like real time of what their expectation is. And you can then go away and you can factor that into your planning. FCCPC originally sounded like they wanted to do something like that. They created negative clearance. Now you're in a world where basically negative clearance is an approval itself. You have to submit a ton of documents, wait a couple of weeks to get it out. It can be frustrating from that perspective. What we need is if we can't clarify everything fully in the regulations, which is hard to do because there's so many different dynamics. It would be helpful if there was some even shorter and significantly less expensive. Look, I know that if I have come for an approval, I will pay, but I'm just trying to clarify so that we can manage expectations around the table of a transaction process. That would make life easier. So I know how much you guys speak to them, but to the extent that you do, I think that's something that it doesn't feel like it's too hard for them to do, but would make life easier for lots of folks.
Okay, thank you very much for your taking that. So I share your view on the fact that, when it was SEC, we could sit down across the table to actually look at the transaction and get live negative clearance, live feedback on transactions. But these days, you have to go through a process and it's documentary and you still have to spend money. And, that money can impact on transaction. Anyway, I hope the FCPC is listening, and this is part of the feedback that I'm sure they are hearing, and hopefully they'll do something about it. I'm back to you on ESG and M&A. So we've looked at what the U.S. Securities and Exchange Commission is doing in terms of announcing its intention to actually mandate ESG reporting as part of registration for listed companies. And basically, they want to use that to cover what is generally termed as greenwashing. Do you think Nigeria is ready for such regulations, seeing that is where you sit? And why do you think we should be looking at such?
Okay. I think Nigeria is ready, and Nigeria is actually already on the track to regulation in this area and generally around sustainability, environmental issues, climate issues. And this should not be surprising, because all around the world, there's what I like to call a meeting of the planets around these issues. And I think the US is only one of a host of other jurisdictions that are looking very closely at these issues. So for example, you have the EU replacing the non-financial reporting directive with the corporate sustainability directive that's going to require all listed companies, all listed companies in the EU, by the way, to introduce mandatory sustainability reporting standards and report in accordance with these standards. And most importantly, when we're talking about adding to costs, to also get external assurance of sustainability information. So it's not just for the companies to put it out, but they need to get external assurance, which goes to the point around ensuring that companies are not greenwashing. They're not just saying, they're not cooking up different stories for people to digest. There's also an external assurance process. And if you've started looking, for example, at the big 4 accounting firms in Nigeria and outside, you can see that they're beefing up their ESG practice groups, I think, in advance of this happening. In Nigeria, we already have the the Code of Corporate Governance that has Principle 26 and 28 that talk about these issues. I'm not going, because of time, I'm just going to mention those 2 principles. But they basically are at the heart of, you should consider sustainability in your business and in all your operations, and you should report. And in fact, you're supposed to report annually on these issues. I think, but the most critical and the most significant development in this area, as far as I'm concerned, for a very long time, is that in November 2022, the FRC, that's the Financial Reporting Council, announced Nigeria's intention to early adopt the International Sustainability Standards Board's sustainability reporting standards. And those are IFRS 1 and IFRS S1 and IFRS S2. IFRS S1 is just general sustainability reporting related issues, and IFRS S2 is related to climate disclosures. So it's right here. I am aware that the FRC is putting together a working group. I think they want to, I'm not speaking for the FRC, but my understanding, just based on meetings that I've been in and some of the working groups from the International Sustainability Standards Board, that they've interacted with the South, stakeholders from the South, is that they will try and do something where they take into consideration stakeholders from different regulators, from different bodies, in order to roll out the mandatory process that they have for these 2 standards. So Samuel, in answer to your question, it is already here. The International Sustainability Standards Board intends to release these standards, I think, around March. FRC has said there will be early adoption. If you remember what FRC did with IFRS, when they were adoption of IFRS, I think it will be that plus whatever learnings they learned from that, and they will roll out to all the public interest entities. If I can take a guess, it will be the kind of public interest entities that they have under the corporate governance code that they will be rolling out to. I think also a lot of people don't know that we have a climate change council that became operational, I think in the last quarter of 2022. So these things are here. And I think Nigerian companies that don't pay attention to getting the appropriate capacity, that don't pay attention as the regulators are developing, the regulators are in the process of developing the kind of designing the structure. And so for companies that feel or believe that these structures will apply to them, they need to start thinking first, what are they talking about? What are these international sustainability? What does the International Sustainability Standards Board mean? What are these two standards, one on general sustainability and one on climate disclosure, that the FRC says it's going to mandate? How do we understand it at a board level, at a management level, at an EXCO level? And how can we engage in the discussion with the FRC, engage in the discussion with the Climate Change Council, so that whatever is created for Nigeria's adoption of those standards, Nigeria's adoption generally of anything that is coming down the pike in these areas, how do we ensure that we're part of the conversation so that the regulator is not going one way and we, the community of those to whom the regulations will apply, are going another way and say, hold on a minute. So for example, I go back to what I was saying about greenhouse gases previously. Greenhouse gas scope 3 is where you're trying to figure out the people in your the entities in your ecosystem that provide the inputs into a product that you provide, that you produce. How much greenhouse gases are they emitting? We don't have right now, to my knowledge, the skill sets to calculate that, because it's very data driven. So if that is part of what is coming down the pipe from the sustainability reporting standards, the climate disclosure standards of the ISSP, industry has to be telling the FRC, if it doesn't know, and I'm not saying it doesn't, that in Nigeria, this is what needs to happen. But if you don't know, or if you're not together as an industry to say that to the FRC, you may find that you don't have you're looking at scans and it has come. So I think this is a time when everyone to whom these standards may potentially apply, and I would say certainly the public interest entities, if you look at what is classified as public interest entities under the code, the national code, start looking in this area and get yourself familiar. And from an M&A perspective, whether you're a target or you're you're an acquirer, how are you dimensioning the risks of all these things? You don't want to buy a company and then you suddenly find out it's subject to all these regulations that you had not imagined, and you're starting from scratch. It's an outlay of capital that you had not even envisaged in the past. Thank you.
Well, thank you very much. So clearly, ESG has come to stay. In Nigeria, we can see that there is a lot of rulemaking being championed by the NGX regulation entity. Chuka, I know that Uru Capital is one of the private equity entities that take ESG very seriously, and you actually invest in ESG, impactful targets. Now, if you look at how do you actually, what are some of the post-close ESG considerations that you look at after an M&A transaction, seeing that you go in there in the first instance, ensure that it meets your compliance requirements? What are those things that you start looking at after the completion of the transaction to ensure that it still meets your standards from your investors and sponsors?
Okay, yes, thank you. A very, very, very practical question. I'll just like to start with from the due diligence, then go into, post-transaction. So during the due diligence stage, the consultant actually evaluates, the company's level of compliance with ESG, and you have the various risk factors. So if the risk factor is really high, then it means that we can't even go in at all. And if it's, depending on the level, especially in Nigeria, it's very difficult to find companies that are 100% ESG compliant. There are usually gaps. Now, if the risk is manageable, then we still go ahead with investments. And thereafter, the expectation is that there would be an action plan to address the issues. So before we invest in a company, it's one of the things that the promoter or the seller has to sign up to, that look, the action plan, they're going to be, we'll have to execute it. And in many cases, hire an ESG manager full-time, who would be there, work with consultants to execute the plan, prepare a management system, and also ensure that, that the ESG initiatives are being implemented. So that is, and post investment, that is what happens. So post investment, it is, you're basically tracking, the key variables on ESG. So be it labor related matters, environmental, governance. So everything is being tracked and reported at the board level.
Okay, well, thank you, Chuka, and thank you, partners. I still have a few questions there, but I think looking at our time, we should go and look at the questions, from the attendees, so we can, look at some of their views and address their concerns as well. It seems from the questions that ESG is quite an interesting topic for a number of the attendants. And I have three related questions here. And one is directly addressed to you, Chuka. And it says that, is the introduction of ESG into deals affecting deal volumes? That's one, just a mind. And the related one is a question from a practitioner, a well-known practitioner, who is asking, are local communities actually considered when transactions, or where the entity is based, where transactions are being implemented? Are they really considered?
Okay. Yes. So the first question is whether the ESG has negatively affected deals, or increase or reduce, basically. I don't see the impact these days. So 10 years ago, ESG was a new thing, and you tell a promoter about the impact of ESG and the importance of doing it, and it's like, okay, I'm not sure you're ready to do a deal. And besides, there are other buyers that were willing to invest without the ESG requirement. But these days, it's everywhere. So whether you look at the equity guys, whether you look at the debt providers, everybody expects that the business that is actually getting money is open to becoming ESG compliant. So I don't see the reduction in deal volume as a result of it. In fact, there is a better opportunity from a company being ESG compliant in the sense that it becomes an attractive acquirer for an international player. And the other thing regarding the local community, so from our perspective at Uhuru, when we're looking at a deal at a very, very early stage, we actually consider the impact on the local community, because it's one of the key considerations when we're, during the ESG evaluation. And if that impact is really negative, it's unlikely that that will go ahead with the transaction. So we don't want a transaction that we fall in love with, and later down the line, during the due diligence stage, we realize that we can't go ahead with it.
Okay, thank you very much, Chuka, on that. Tino, I have a question here for you, and I think you've mentioned something around it, but perhaps this participant wants a clearer picture. The question is there anything the government and government agencies can do to ingrain ESG awareness in M&A deals in Nigeria going forward?
Yes, and I think that they're already doing it. First of all, like I promised to come back with FPI numbers for December,
Yes.
and the FPI numbers that we're seeing in December is domestic 89% and foreign 11%. So that's like a huge fall from the numbers that we used to see in the past. So I just wanted to put that piece of information out there. Okay, so I think some of the things that have been done already are leading to what Chuka is seeing, where people, it's not only the effect from outside, but the effect internally. So since 2012, for example, there have been sustainable banking principles, the Financial Sector Regulatory Coordinating Committee, which is a committee of all the regulators in the financial services sector, has had sustainability principles that have been ingrained, that they've required to be ingrained in their regulated entities. And I think the one from the SEC, the principles from the SEC came out last year, and we're expected to see reporting on that already. So I think what you will find is, if you find any company in the financial sector, because of those principles, there would be something relating to ESG already that the entities within that regulated sector are required to deal with. So for example, with the banks, and you can see it with the number of female CEOs that you now have, it didn't happen by surprise. It happened because the CBN was very deliberate around, tracking through management, a track for women to be able to get to the executive level. And now you're seeing women directors around very specific policies. So if you're doing an M&A there, you will be affected by the ESG factors there. Then we have our corporate governance code that has all these requirements around communication with your stakeholders, has all these requirements around the community in which you do business. These are the lesser known areas of the code, but if somebody is doing due diligence and they're being thorough, they will go through the entire code. And I think some of my colleagues on this panel have talked about how the diligence is becoming more and more thorough. So before, you might have been looking at things of just like, oh, do you have an audit committee? Do you have an internal auditor? And does he have a direct line both to the audit committee of the board as well as a reporting an administrative line to the CEO? What I think I'm hearing, even though I'm not in the M&A space, but just tangentially from being in the market, is more and more detail. And then the kinds of questions that we are also being asked to answer around entities that are within our regulated space show me that the ESG is seeping through. And I think the real kicker will come when the FRC deals with this ISSB standard 1 and ISSB standard 2, just as you saw it with IFRS. And a couple of years ago when IFRS came, well, like, oh my gosh, it's going to change. How are people going to do it? How are they going to get the capacity? Once the regulator puts the foot on the pedal, as they will do, as they're planning to do with the sustainability standards, I think the pockets that you've seen in different regulators and some of those lesser known areas of codes, they will come to the fore. And we'll see, we're having this conversation in 2 years' time. I'm quite sure it will be a different type of conversation. It will be concrete examples of these issues coming up in deals. Thank you.
Thank you very much. I have other very interesting questions. Unfortunately, our time is fast spent. I really must thank the panelists for their very insightful and very practical discussion of this topic. I believe that in the course of this discussion, we've been able to see that although there are challenges in the M&A space, the volume really hasn't really dropped. And in fact, there are even opportunities. And as Dipo was quick to say, politics is local. If you're interested in a space like Nigeria, emerging markets, generally, you should be ready for the challenges, and embedded in those challenges are actually opportunities. And Chuka has also made us realize that, look, this is the time for real investment managers. This is the time for real PE practitioners to really show what they're worth, and also a lot of opportunities coming from the ESG space. We can also see that there are quite a lot of activities from the regulation side, and the benefit of ESG that is becoming widespread. And we're seeing that even though a lot of concentration right now, at least on entities, that are listed or regulated entities as they're called, the ESG paradigm is actually affecting everyone, and everybody is actually encouraged and in their interest to be to onboard ESG as part of their practices, because it affects deal valuation, it affects investors' confidence, and it affects even the future prospect, of the businesses. A special thank you to you, Tinu, for taking your time. I understand the challenges that you face. Thank you very much. We appreciate your time. Chuka, Dipo, your perspectives are, very welcome, practical, and we believe that for the people who have participated, you found one or two useful insights. Apologies that we couldn't take some of your very interesting questions that I'm looking at here. It pains me to not, ask those questions, because I believe that we'll have had an interesting perspective. But feel free to share these questions, with us. I believe that we'll share an email subsequently where you can send these questions. For everyone participating, thank you very much. I believe we've actually learned one or two things, from these panelists, and it's been a good use of your 1.5 hours. Thank you very much. Joe, round up.
Joe is muted.
You're muted, Joe.
Sorry about that, everyone.
Yep.
Thank you for watching. We'll see you next time. That was an amazingly interesting discussion. Yeah. Have a great rest of the day, everyone. Goodbye.